Stock markets may be about to get more volatile, and here are 5 reasons why. Number 1, the pandemic. A new wave of infections may have already started at the global level. Infections are surging in the United Kingdom, raising the likelihood of a similar surge soon in the United States. Case numbers are also turning in Asia. This will slow or at least temporarily halt reopening. Number 2, the high growth, low inflation narrative will start to wear a bit thin. The Federal Reserve and the US Treasury continue to chant that mantra that inflation is transitory. But US inflation, both headline and core inflation, has not taken a single backward step since the start of the year. Number 3, now, even as inflation pushes higher, the economy will find it harder to impress with an encore performance. The 2021 economic recovery is already in the price, past tense. And as we progress through second half of 2021, the markets will look more at the slower economic growth rates expected for 2022. Number 4, corporate earnings also face that same problem of producing an encore capable of impressing the market. Just as we have seen peak economic growth, we are likely also to have seen peak earnings growth. The market is expecting 37% earnings growth for 2021. This is almost at the 40% growth peak post the global financial crisis. Finally, number 5, there are hints of market discontent in the divergences between the S&P 500 and the Dow Jones Transportation Index, and between the S&P 500 against that risk-on, risk-off currency pair, the Aussie yen. They are not confirming the rise in the S&P 500 since June. The bull market is unlikely to be over yet, but a correction is a growing risk.